We aren't looking for hard work this year. We are looking for a soft life. It is not difficult to learn how to invest. It is not difficult to be an investor. Do it the way wealthy people have been doing for hundreds of years. Hello and welcome to the podcast. I'm so excited to have you here. I'm going to be sharing the 3 things that I will be doing this year to make sure that I am set up for success. And that includes the friendship circle method, the give them a chance method, and also the burn book method, the investments that we are not going to be making this year. Oftentimes there's so much information out there that it gets so overwhelming and you end up thinking, maybe this just is not for me. Maybe I am just not a maths girly. Maybe this is just not the place that I'm going to be. And I'm here to tell you that that is not true. It is not difficult to learn how to invest. It is not difficult to be an investor. With the first step to becoming a better investor in 2025 and making sure that you are just setting yourself up for the wealthiest year yet is called the friendship circle method. If you are setting up your dream friendship group and you're like, okay, girls, let's just sit down, let's figure it out. Who is going to make up my friends? You're going to have a fun local friend, a fun international friend, and you're going to have a stable friend. When you are young and in your 20s, you probably want to see your local fun friend and your international fun friend a lot more than your stable friend. Because your stable friend, you're going to be like, hey, I'm seeing the sky, I don't know what to do. And your stable friend's going to be like, this sounds really toxic. Why would you give me sound, sensible advice? That is crazy. You're going to go to the friend that is just as crazy as you, that's going to be like, yeah, do it. Just keep going. And so your fun friends are the friends that give you a lot of excitement, but there's also lots of highs and lows with them. Your stable friend is obviously a bit more stable, not as many highs and lows, but then the risks of things going wrong are also lower. When it comes to investing, it is the exact same. In the same way that you make up a portfolio of your 3 friends, we can make up a portfolio of 3 different funds. And these funds are baskets filled with lots of different companies, rather than trying to pick and choose individual stocks of companies and being like, oh, well, Tesla's doing this and Apple's doing this and Nvidia's doing this. Let me jump in and that's really a lot of hard work. And we aren't looking for hard work this year. We are looking for a soft life. We are looking for a simple life. We are looking to have fun and be financially smart, but not be sitting in front of an Excel spreadsheet all day long, because I don't want to do that. And I love numbers. I love data. If I'm stressed, I just plan and I sit down and I plan and I look at Excel spreadsheets because that is what I enjoy. And that's fine. But I don't want to be doing that forever and ever and ever. So imagine we are setting up this fund, this portfolio of investments based on the 3 friend groups. We've got the fun international friend, the fun local friend, and the stable friend. The fun local friend is a S&P 500 fund, which is the top 500 companies in the US, but you can also swap this out for the country that you're in. If you're in the UK, it's the FTSE 100. If you're in Australia, it's the ASX 200. If you're in New Zealand, the NZX 50. You don't have to make this your local fund. If you're like, hey, I live in Australia, but I actually want to invest in the US because the market is larger there, then you can invest in the S&P 500, the top 500 companies in the US. And this fund is a passively investing fund. So what that means is you're ending up basically investing in the top 500 companies. So think Apple, Amazon, Google, Facebook, Microsoft, and any of those upcoming companies that make it on the list automatically shuffle in. So you end up investing in maybe smaller companies, mid-cap companies, not small cap, but mid-cap companies that move up the list, and your investments get to move with it. And it is with low management fees and it is passive. So we like investing in that fund. But that fund is 100% stocks. It is your fun friend, but it's also just kind of kept to one market. And what if you go traveling? What if you go other places? You don't want to just have your local friend. So we also want to invest in the second fund, the fun international friend, because this is a friend that lives a really cool life and she lives in different parts of the world and she's so exciting and she's so worldly, and you're like, wow, you go visit her apartment and she's living by herself and it's all decorated well, and you're just like, I want to be you when I grow up. And this friend is amazing, but visiting this friend, they definitely have a little bit of a higher risk tolerance. This friend is going to be like, let's go out to town, and you're like, I am in another country, I do not know these people, I don't know if I want to go out and meet these other friends that you've made. And so there's a little bit more of a risk compared to your local fund friend. And it is the exact same in the share market. Your international fund friend is also going to be your international fund that you're creating. And this fund is filled with the top companies from emerging markets. So this might be like the fund VT, which is a Vanguard fund. Again, low fees. We love Vanguard for their low fees, but you can invest in any fund that does the exact same thing. And this fund is filled with top companies from around the world. So think of emerging companies from Japan, emerging companies from Taiwan, China, India. VT, however, does have a lot of US companies. So if you don't want any exposure to the US, then there are other funds that have like VT exclusion US. And so there's a few different ways that you can invest. What that means is as other markets start growing, your money will grow as well. It is more riskier, however, and it goes down more than an S&P 500 fund because emerging markets have a little bit more volatility to them. The third fund, which is the stable friend that we're having, is of course the stable fund. And this is what we're going to call a bond ETF, an exchange traded fund, a basket filled with lots of bonds. And bonds are basically when you get to be the person, the bank, and you're like, hey, I am looking to just figure out a way to give my money to someone and they give that money back to me. And it's almost guaranteed that they will, but maybe they won't give me a high return. So oftentimes you will act like a bank and you will give your money to corporates or governments, government bonds, and they will be like, thank you so much, Sim. I will take this $1,000. I'll give it back to you over the next few years, and I'll give you a 2% or like 4% return on your $1,000. And you might say to yourself, and I'll give you a 2% or 5% return on the money that you've given me. And the benefit is you are more than likely to get your money back. It's very unlikely that you will lose your money, but you're getting a much lower return, maybe 2%, maybe 4%, whereas your US S&P 500 fund would give you like a 7% return, and maybe your international fund could range between, minus something in some years and plus something in some years. It's a little bit more unequal. And so by having these three friends, you've now figured out your portfolio that you're investing in. And as your age changes, you start changing how often you see different friends. The older you get, the more you will have bonds in your portfolio. Maybe you'll have 30% bonds and only 70% of the other two funds. And then maybe when you're 60 and you're getting closer to retiring, you'll have 60% or 70, even 80% bonds and the other side of your individual companies that are in those funds. And so it gets a little bit easier to understand. If you're not sure, I like thinking of this sort of rule where you look at the decade that you are in. So if you are in your 30s, let's say you're 37, then in your 30s, you want to have 30% bonds and 70% shares. If you are 21, you're in your 20s, so you only want to have 20% bonds and 80% shares. And so that's a nice way of making sure that you have your perfect friendship circle. The second thing that I'm going to be doing is making sure, and I kind of love this method, it's called the give them a chance method, because how many times in our lives have we seen our friends give people chances that do not deserve that chance? How many times have we been the clown that have given people chances in our lives that absolutely do not deserve a second chance, a third chance, a fourth chance, a fifth chance? And yet we give it to these people. And I have this belief that if you are so comfortable with giving a man a chance time and time again, then you should be okay with giving your investments a chance to succeed. Hear me out. What I believe in doing with the give them a chance method is understanding that when you're investing, we are investing for the long term. In the same way that when you see someone do something so stupid and you're like very much contemplating what on earth you're doing there, you often say no, but like think of the potential, think of the potential, think of the future. And we do this with people, but we do not do this with our own money. And it is so important that when you're investing for the long term, I'm talking 10, 20, 30 years. We're not here to get rich fast and like get into scams and pump and dump schemes. We're here to get rich slowly, to get rich consistently, do it the way wealthy people have been doing for hundreds of years. We're going to take that information, and what that information says and what the studies say is get rich slowly by buying and holding your investments for a long period of time. Dalba, a financial services platform, in 2022 published a report on how investors were behaving, and they found that investors who tried to time the market or actively trade, so trying to buy different companies and trying to get and jump in and be like, oh my God, Nvidia's growing, let me quickly buy, or Tesla's growing, let me quickly buy, they always seem to underperform the market long term. In fact, in this report, they found that investors that were trying to actively trade over a 20-year period made 7% returns in the market. But the investors that were like, look, I'm just going to do that sort of friendship circle investment method. It's also called the lazy method or the bogglehead method. And I'm going to just invest in 3 different funds and just let it ride out. Those investors made 10.6% returns, a 3% return greater than if you were trying to time the market. And a 3% return every single year, greater for 20 years, really adds up. That's hundreds of thousands, if not millions of dollars more. And another way to think about this is the efficient hypothesis method, which is this idea that investments are already priced in. People have already put into the idea that you cannot beat the market. Even professional investors find it very difficult to beat the market. So why are we going to try and do that ourselves? It just doesn't make sense. It is like saying, I am going to predict what this man is going to do in the next 5, 10, 15 years. We are not going off potential anymore. Potential is out the door. Potential sits in a corner and we shut that door and we do not open it. We are dealing with what we see right now. And in the same way, when it comes to your investments, rather than hoping like, well, I think that this industry might do well, so I'm going to guess and jump into that and hope for potential by investing in one single company, we are not doing that. We are going to buy and hold. We are going to diversify our investments by putting them in different funds. We are going to buy them and then we are going to hold them. And when those investments drop in value, because they will, the market does fluctuate, we have to remind ourselves that it fluctuates in the short term. If you look at what the S&P 500 has done in the last 5 years, you will see it moving up and down. But if you see what it's done in the last 10 years, you will see that while it's moved up and down, it has moved more consistently upwards, even with issues like the GFC, the Gulf War, when we had COVID, when we had presidential elections, it can move in a way that is quite volatile. And while past performance does not guarantee future success, over the last 40 years, the S&P 500 has shown a gradual increase of about 7% per annum when looking at it over a long term. Sometimes it's down 10%, sometimes it's up 20%, but assuming 7% has been what professionals have advised and what studies have recommended. Now you might be thinking, okay, Sim, I've got my circle, I've got my give them a chance method. I get that if I keep giving people chances, I should probably give my investments a chance. When they drop in value, I'm going to look away. I'm just going to close my eyes and I'm just going to continue to invest for long term. The third thing that I am going to do this year to make sure it is my wealthiest year yet is the burn book method. Making sure that I am not investing in certain things. These types of investments are in my personal burn book. These types of investments are things that I am not touching with a 10-foot pole. This is the type of investment that comes up to a party really messy. They're the type of investment that is just so all over the place. They smell like smoke. They don't have their life together. And I just cannot have that in my little circle, because it's just, maybe I wanted that when I was younger, but I'm getting older now. I'm growing up. And so this is what I'm doing. Of the 5 investments in my burn book and the investments that I am not making this year, the first is anything that guarantees a 7% or more return. Any investor that says to you, or any company that says to you, hey, invest in our fund, especially those real estate funds where people like developers will be like, hey, give us some money and we will give you a 10% guarantee return. That is illegal. You cannot guarantee returns anywhere. If someone says to me, I have this real estate company and I need money from you so that I can fund these real estate developments, I'm going to sell them for more money and I'll give you, 10% returns every single month. If I ask them, is this guaranteed? And they say yes, I am walking away and I'm probably calling the police as well. Well, at least the financial police, because That is not what you can do. You cannot guarantee returns. And so if something ever comes up and it seems too good to be true, and they're like 12% guaranteed returns, just remember, Sim said, unless it is like 7% or under, nothing is guaranteed. And that is not fair, illegal, or something that I am giving any of my time to. The next investment that is in my burn book that I am not putting my money in this year is penny stocks. Penny stocks are stocks of companies. Now think of stocks as little certificates where you get to own a small piece of a company. And penny stocks are having certificates of very, very tiny companies. So companies sometimes have large market caps where they're worth over $1 billion or $2 billion. Then they might be medium size, so mid-cap companies or small cap companies. And even small cap companies are companies that have millions and millions and millions of dollars in revenue and are worth, tens, if not hundreds of millions of dollars. So we like that. Penny stock companies are companies where the share price of that company trades for less than $5. So it's trading maybe $1 on the share market or $2. And these do not make it to the large stock markets, the large stock exchanges. So they are not listed on the NASDAQ or the New York Stock Exchange or the Australian Stock Exchange. They are over-the-counter stocks. And these are actually what the Wolf of Wall Street was using when he was trading the pink sheets, the pink slips. And penny stocks are very, very high risk because the chance that this is going to go from a small, tiny, not illegitimate, but, small company into a large, substantial company and make it onto the share market in terms of like the NASDAQ or the New York Stock Exchange, that is very unlikely. And some people can make a lot of money from penny stocks, but the risk is super, super high for hopefully a very high reward. But there's also a chance that you have a very strong downfall. And so for me, that is on my no-go list, even though it can seem really tempting and it can seem like something that you can make quick money from. The next investment that is in my burn book for this year is high-yield junk bonds. Now, high-yield bonds or high-yield junk bonds are basically bonds, and we've talked about bonds already in this episode, bonds that end up saying, we are going to give you a very, very high yield, like Sim, I know we're just a bond, but we are going to give you 7% returns guaranteed. And you need to know that bonds that promise more than what other bonds are giving often do so because they have a lower credit rating on the bond purchaser that is grabbing it from you. And this person on the other side of this company is more likely to not do as well, and your likelihood of getting that money back is lower. So again, you are going to take on more of a risk to hopefully get more returns, but it just does not make sense for me, especially during times where we have economic downturn. That is the worst time to be investing in something like this. The other investments that are in my burn book are anything that do not have intrinsic value. Now, when I talk about cryptocurrency in particular, I think Bitcoin has intrinsic value. I think Ethereum has intrinsic value. I think there are investments out there where they can be used for good. You can buy certain cryptocurrency and the ability to transfer that money overseas in a way that is so much simpler. Like when Ukraine was part of the crisis that they started going through, it was very, very difficult for them to get funding. And then when they put a tweet out and were like, hey, can you send us money through cryptocurrency? Like millions of dollars were sent, and it was much faster and easier than if they were trying to set up, an online payment portal through a bank or something that just was not going to be easy to do and ended up becoming quite redundant. There's, however, lots of alternative coins that are being made right now, especially this year. And with the rise of Bitcoin, it is very easy to think, oh my God, I missed out on Bitcoin. Let me start investing in just other coins that are maybe new and smaller, and let me just try and make a quick dollar. It is not my personal belief to invest in anything that does not have intrinsic value. Because if it doesn't have intrinsic value, one day someone will say, this is overpriced and this isn't something I can sell. If you at least buy a share of a company, the share price changes based on what the market does, based on what the company does, what they sell, how much revenue they have, how their price to earnings compares. And so that can change because there's something physical there, something intrinsic there that you can put a dollar price on. You cannot do that with NFTs. You cannot do that with alternative cryptocurrencies. You cannot do that with things that really just do not hold value. And so for me, that is out. And the last one, and this is probably the hardest thing that is in my investment burn book, probably the one that I will struggle with the most, is anything that has been given to me as a hot tip that I don't necessarily understand, but I'm like, oh, well, I don't want to miss out. A study was done and found that 30% of investors, like 1 out of 3 of us, have ended up purchasing an investment, a company, just because we were told that our friends were buying them and we did not want to miss out. And we were like, fine, I'll just quickly jump in. That is not the best way to invest. When you are looking at how to invest, I always think about what Warren Buffett said, where he didn't invest in a lot of tech companies. So he missed out on the gains that Google had made quite early on. He was not one of their first investors. Same with a lot of other software and IT companies. But he says that he's happy to have lost out on those gains because he didn't understand how Google was going to make money. He did not understand how Facebook was going to make money. And so he would rather miss out on something that he does not understand than look like someone that's worried about, I don't know, appearing not intelligent and just jumping in and being like, yeah, well, so-and-so's invested, so I should invest too. I mean, so much of the venture investment world, I'm an LP. I see what people do when it comes to venture investing with venture capital, where they put money in like startups like Airbnb before they grew, or, Uber before they grew. So many people in that space will go, oh my God, well, Sequoia is investing, so I should just invest. Or, A16Z is investing, or YC backed them, so we should invest. And sometimes people do not do their due diligence and end up getting burned. So even when professionals suffer from FOMO, know that it is okay as an individual investor to also suffer from FOMO, but know that we are not going to do that this year. We're going to pull back. We're going to invest in things we understand, and we're going to make sure that we have a wealthy year this year. So by following the friendship circle method, the give them a chance method in my burn book, I am making sure that I'm setting myself up for success. I'm investing in things that make sense. I'm investing in things that matter. And I am so excited to live more of a life where I have freedom to do other things, because my investments are growing and my portfolio is increasing, and I'm able to start eventually living off these investments. Like, that is just true freedom for me. And I'm so excited that taking the steps now is going to make it so much easier coming up. Now, if you've enjoyed this episode, please take a screenshot, send it to your friend, share it. The more people subscribing to this gives us more of a chance to grow the team, have better information, have more research, have more facts, have amazing guests. So if you could do one thing for me, leave a review, leave a comment, whatever you can, just share it with someone that you believe needs this kind of information, because at the end of the day, it gets it out there more. More people learn how to invest and live wealthier lives, and what more can we ask for? So with that, I'll see you next week.